All right, let's get to it. Next, we are going to be talking about stablecoins as the next settlement layer. Lucky to be joined by two people who are very knowledgeable on it and come from at very different angles and very different industries. So again, just to open things up, I want to give you both a chance to introduce yourself. Spencer, I'll kick off with you.
Hi everyone, I'm Spencer Jaffe. I'm at Circle. I manage our blockchain partnerships.
Hey there, Kyle Hauptman, Chairman of National Credit Union Administration. That's a government agency. If you know what FDIC is for banks, it is the same thing for America's 4,000 credit unions.
Thank you very much. All right, I'm just going to get right into it. I know everyone's time here is valuable. Spencer, give us the bull case. What's going to make stablecoins the settlement layer rather than just a tool for payments?
It really comes down to institutional adoption and making sure that if you are a business, if you're, no matter what stage, you're a small business, you're a large business, you're a major enterprise, it really comes down to just do you still want to have this T+2, this T+2 settlement that happens currently? Do you still want to rely on more antiquated banking rails, on technology that frankly hasn't been updated in a very long time? We have an opportunity here to really disrupt the current ecosystem, the current world that we live in, and stablecoins are a very, very all-in-one solution to enable instant settlement, instant finality, and to provide just greater access of capital to a much wider range of individuals, both within this country and also internationally.
Yeah, Chairman, when you hear the name of this panel, stablecoins is the next settlement layer, do you hear a risk? Do you hear an upgrade? Both?
It'll be an upgrade if people want it to be an upgrade, right? There's no point in anybody trying these things out unless it's better, right? People can make their own decisions. By the way, when you say T+2, one thing about America that is even more antiquated, it's not the 2. That's 2 business days. You trade on Friday, 2 days later, Sunday, right? Does that mean it settles on Sunday? No. It's 2 business days. We still use the phrase business days. As advanced as this country is, and I believe we have 18 of the 20 largest tech companies in the world, there are still 114 days this year. Every day I'm waiting for a tax refund I could really use right now, right? I keep saying, did it arrive today? Did it arrive today? Did it arrive today? There's 114 days that I don't have to bother checking because our government still only pays on certain days. And a lot of transactions like that. So that's even weird. So that's one aspect of upgrade. Is this thing working, by the way? It's going in and out, right? Okay, all right. Hopefully every day is a business day. All 24 hours a day are the same. We don't have ACH cutoffs. There are countries we give foreign aid to that already have this. So that's one thing I'm excited about. We don't have to have these strange counter effects 24 hours. So that part will be an upgrade. The programmability seems to be an upgrade. I think it's starting already in credit unions. In normal transactions, nothing new, but just a new way to do it. If I can mention loan participations for a second, they're big in credit unions, small banks, which is, Spencer makes a big loan to Brandon, and I say, all right, my credit union will buy 10% participation. We don't actually buy the loan. I just go in, I'll take 10% of the cash flows, good or bad, right? This is a very normal thing. Well, every month right now is a problem stablecoins can solve. I have to ask every month, hey, did he pay you yet this month? And 2, when am I getting my piece? We should all be on the same chain. We all have the same information. All right, I'll use this. It's easier. All right, thank you. Anyway, a programmable money and a blockchain solves that, right? We all have the same information at the same time. And I don't have to trust anymore. And right? Because sometimes, there's a late payment. Well, you got to give your 10% of that too. Well, I don't know if it came in late. They often settle up on the 15th of the month, right? All these loan participations. And let's say after the 10th, it's late. Comes in on the 11th, it's a late fee. I don't know if I'm getting my 10%. I have no idea. I can't see this transaction. So that's what I mean by an upgrade, in that to start with, it's the same old stuff, just done in a more frictionless way.
Yeah, I think that's really interesting and definitely something I learned just now. I didn't realize that T+2 is not the world standard at the moment. I know crypto definitely upgrades that. But Spencer, I want to focus with, pitch this question to you. In terms of what can settle on chain today, What have been the latest advancements that have excited you, in terms of what can settle on chain today, as opposed to maybe a couple years ago?
I mean, I think it's just the assets that are available on chain today versus 2 years ago, 5 years ago. Back in the day, for those that remember, in 2016 when Coinbase kind of emerged, and we're all excited about, oh, this is a speculative asset. It's no longer about speculation. It's about bringing a financial system that exists all around us today and moving it into a new venue. There is on-chain stock trading, there's on-chain derivatives, there's commodities like tokenized real estate, private equity, venture capital, so many different assets that are now available for anyone to be able to access, in certain ways and certain venues. And I just think that the possibilities are really limitless. Like, we were recreating the economy in the financial world in a venue that is faster, more frictionless, and frankly, less expensive than the one that is out there today. I think it just opens up so many opportunities. And we're still only just at the very beginning of that, because one day we'll see commodities markets are open 24/5 in the current world that we live in. That can be 24/7. All of a sudden, you have the ability to hedge on weekends against macro events. Stock trading is 9:30 in the morning till 4 p.m., Monday through Friday, off on holidays. All of a sudden, you have the ability to be 24/7 all the time. You can respond in real time to company news or events or things that happen. You're able to have much greater price discovery, which I think just creates a much more rich environment and an ability to, if we want a real open economy, this is just a great path forward.
With that said, so it sounds like we have a brave new world, right? A rich world of new assets, new markets coming on chain. Everything's seemingly available, at least where we sit, being entrenched in the industry. Chairman, I'm curious on your end, what do you think stands between today's market and institutional scale?
Well, government, us, right? Americans are, we're the best in the world at monetizing innovation. I don't care if we invent it, we monetize it best, right? There's been three big things in my life, in my opinion: internet itself, crypto, and AI. Crypto is different than the other two when it comes to politics, because it's very difficult for government to see the benefits themselves, because you don't really use it the same way. And by the way, myself, everybody else in the executive branch, I'm not allowed to own one single dollar of a digital assets, okay? Not $1. Same with Treasury, SEC, et cetera. It doesn't even make the de minimis list. Office of Government Ethics has rules about conflict of interest, but they have a de minimis amount. You can work at the FAA and own up to 15 grand of American Airlines stock. No, I don't bother with any of this stuff. That sort of thing, right? I could own a small amount of a bank stock. They don't even allow that, a de minimis amount, nor can your spouse, nor can your children. So for years, when people went into the SEC and Treasury and said, these guys don't really get it, well, yeah, they don't. Neither they nor their children or their family have ever used this if they're following the rules. So that's one issue with government. But my point is that governments use AI for years. They use it on tax returns. The NSA's used it for years. And I'm a Republican appointee, but I routinely credit the Clinton-Gore administration for one of the best things I think that's happened since I've been alive. 1997, principles for this new thing called the internet. You should go read it. It is a trip to read the language that they use. Number one, the government should lead. Okay? They put this on whitehouse.gov, a website that only existed for 2 years. Well, anyway, so that's the problem crypto has. You ask what the barrier is? It's that. And so when all you hear about is the negatives, because sure, there's negatives. Every new tech does. And every new tech is going to have major issues if it is widely adopted. You guys know there were 0 plane crashes before we had planes? Right. Not a one. When I was born, 0 internet viruses. You know why? We didn't have the internet. And so there's always problems. But the association with criminality, Hamas got 1% of its funding, crypto. Well, Hamas also uses cell phones. You think they're bad? They use laptops. You think those are bad? No, it's because that's all they knew, because you couldn't see the mainstream uses. Again, with AI and with the internet, when Clinton White House staffers were, oh my goodness, email, we don't have to use paper memos, they could see it was useful. So the bad stuff with the internet or with AI, you didn't think AI bad, you didn't think internet bad, because you saw all the positives, okay? A plane crash doesn't mean planes are bad. It means a plane crash was bad. So that has been the biggest problem, and it's a shame because this country, I think we agree, it's another industry we could dominate and get the most value. With all new tech, you're going to get the downside. Every country in the world has auto crashes every day, fatalities, but only a few have auto industries. Every country has ransomware and all that nasty stuff. Only a few countries have terrific paying jobs in cybersecurity and so you're going to get the negative. Our friends in Canada and Mexico, guess what? The economic displacement, I don't mean just like evil things like ransomware, but just economic displacement. Our friends in Mexico and Canada, guess what? They lost all their video rental jobs too. Nobody rewinding a tape in Guadalajara, right? But we lost those jobs, except what's the difference? Only our country is where you can work at Hulu headquarters and Netflix and be one of the early employees with life-changing wealth, or be the angel investor or the endowment fund that benefits. You're going to get the negative. See, what we're good at in this country is grabbing all the upside. So that's a long answer as to what the impediment is. And I would like to see government try to use stablecoins as quickly as possible for something, even internal government-to-government payments between agencies, because the more government uses the tool itself, the better off the industry is. And maybe even retail payments. Maybe I could get my tax refund 365 days a year. Imagine that. Or your mom's Social Security payment. It'd be terrific. And guess what? Someday we're going to have another March 2020. We're going to have another COVID. We're going to have a situation where it's an emergency. And we need to get a whole bunch of money very quickly and securely into somebody's hands. And in this country, 18 of the 20 largest tech companies in the world, you know what we did? There were 5 weeks of ACH. These are the stimulus payments. 5 weeks of ACH followed by paper checks, 40 million to old addresses. There were people who had not filed yet for 2019 or 2018. Paper checks. Remember, this was emergency. This was feed the kids money, not get evicted money. The best we could do for 40 million people was paper checks to addresses that by definition were old, because there were people who hadn't filed the last 2 years. Anyway, the government itself needs to get to use this because it's useful, and that will have a downstream effect on how it treats the industry.
That is fascinating. I appreciate the thoughtful response there. I want to linger on it for a second because you mentioned something that I didn't know. Is that no one internally is allowed to even interact with anything blockchain related. I mean, digital
own it, not $1.
Cannot own it. So that means, technically ownership is if it's in your MetaMask wallet. We just had a fireside chat up here about part of the mandate at the Fed was to integrate AI into your workflow. I think it's extremely important to, at least interact and use these platforms. Why is a crypto not one of these things? Like what's stopping?
Well, probably it wasn't at retail, right? Because the only ways normal people interact with it, either you own it, and that's the single biggest voting block, right? The last election found out there's not a huge voting block of crypto employees like with other industries, like farming employs a lot of people. That's a major political force, right? Manufacturing, et cetera. There's not a lot of employees, so that's usually a political voting block. But there were a lot of crypto owners, and they talk to each other, and some of whom are sort of one-issue voters about this thing. And there isn't an equivalent anti-crypto voice. Okay, even people don't like crypto, like it's not their thing the way it is for pro-crypto people. In terms of the ownership, that would have to be an ethics thing. I mean, I kind of get it in a way, but I can't even own an index with it in it. I could own, like if Circle wound up in the S&P 500, and I own the S&P 500, okay, then fine, I could wind up owning Circle, but it's just, we just own index funds. That part I think is not important, but once the government starts using it, it will help when someday there's a disaster with stablecoins. When a transaction fails, when God forbid one of these stablecoins isn't stable, and there's going to be a sob story and it's real, the more the government's using it, the less they're going to blame the chain, crypto, stablecoin, and they will then blame the particular situation. Because right now it's way too easy. Remember the association with criminality? I think it's still there. I testified last month and I got blasted about this because I suggested what I did to you, that the government use it. I still remember 2 years ago. We've come a long way. I wasn't chairman at the time, but we put out guidance modeled after the Clinton-Gore guidance on the internet. And member of Congress, are you going to use credit unions, use crypto, the thing that criminals use for illicit finance? I said, listen, if you think criminals often use crypto, you're going to freak out when you hear about cash.
Yeah. Definitely. I totally agree. I feel like that conversation it causes a lot of sidetracking and sort of shifts conversations in a direction that's against progress. So I appreciate your position on that. Spencer, I want to flip it over to you. I want to talk stablecoins directly and focus on the Genius Act. With the separation of yield through the new sort of proposed Genius Act, from your perspective at Circle, what are the downstream effects of what's happened to yield in the Genius Act for the individual, but also as the issuer?
Well, as the issuer, it's there's a way to monetize stablecoins, and one of the ways is there's many ways to monetize stablecoins. One of the ways is the underlying yield. The fact that we are not able to do any pass through to end users, obviously we can still function as a business, but I do think that this is obviously views are my own, all that stuff, but I think that there's a huge value add to being able to interact with our end user in a way that, in the similar way that banks interact with the end user, and for us to be able to, to support them in that way, or to be able to work with a variety of new use cases or new users, it just unlocks a lot of opportunity. And so, we are able, Genius was an incredibly important bill, and that was the way that we can operate, and we know our jurisdictions, we know how we can be here in the United States. We also are using that as a way to say, can we use this as a framework to operate in other countries, in other jurisdictions? And so, Genius has been incredibly important, and clarity to that point is also very important because it allows us to expand upon the use cases that we could potentially interact with and operate in.
Yeah, definitely. Chairman, you mentioned that the NCUA is exploring potential stablecoins for credit institutions, credit unions to leverage. Looking at through that lens, do you expect there to be a few national issuers, or is there going to be every single person, every single institution that has their own?
Just to clarify, I didn't decide to explore it. Congress ordered us to do rules by the Genius Act. The deadline is Saturday, and if you haven't noticed, we ain't going to make it, neither is anybody else. But however, in terms of going into effect, those restaurants where they won't seat you until the whole party's there? It doesn't matter at all if you're the second to last person, because you don't affect anything. Only the person who comes last actually affected the table. So my goal is just not to be that person, so we're not going to be the last one. That'll probably be the Fed. They still haven't put out, they haven't put out a single rule. Our rules, we've put everything out, the comment period ends, so we were supposed to have everything done, published, final rule by July 18. We've at least got all our rules out. We have two. First one on how to apply to be an issuer is done and dusted. Good. Second one on the standards is out. Comment period ended. In theory, on Saturday, on the deadline, we could just say, okay, comment period's over, and then publish it the next day. But that means you didn't really read the comments. We'll have those. And by the way, just so you know, so July 18 was 1 year, right? Because it was July 18, 2025 when they passed it. Gave 1 year. They knew the mistakes from Dodd-Frank. That was 2010, 16 years later. A lot of rules still ain't written. They knew that having deadlines matter. The other one to have in your head is September 18. A lot of people aren't talking about that. The reason is because in order to pressure to get this done, knowing how agencies operate, they said 1 year to get the rules, but then January of 2027, January 18, it takes effect then, or 120 days after an agency publishes the final rule, okay? So if you do the math on that, if we, the regulatory agencies, want it to be our rules that actually govern the launch of this, it's September 18th, because it's the sooner of January or 120 days after we publish the rules. Therefore, go back 120 days from January, you're in September. So that's kind of the other deadline to have in your head, because it takes effect with or without our rules, whichever comes first. And the only way it can be 120 days after our rules are published is to publish it in September. So I still don't know if everybody's going to make that deadline, but that's what's going on. And listen, it's not up to us what people do or don't do. The credit union subsidiary, it's called a CUSO, Credit Union Service Organization. They are the issuer. Whether they use, everybody does one, whether they all wind up sharing one, that's not really up to us nor our purview.
I appreciate that insight on that topic. It's sort of along the same lines, and maybe Spencer, you can lead this off, and but feel free to hop in. In regards to stablecoins, if you have basically every large institution end up issuing their own, what are the downstream effects of that? Is that just healthy competition, or is that a fragmented industry? Where do you see the future of that?
I mean, I think of it as I personally will see it as a fragmented industry. Would JP Morgan dollar really be able to interact with Bank of America? Like, probably not. I think of it back in the 1800s, every bank actually had their own currency, and every state had different currencies, and sometimes there were multiple currencies in each state. And that was not a system that worked very well. I think that it is important to have kind of one or a handful of stablecoins that are able to be accepted by everyone and not have this kind of like quote unquote like war of stablecoins where you have, JP Morgan launches a stablecoin, and then Bank of America launches a stablecoin, and then Societe Generale, and then all of a sudden you have all these different coins that are all technically backed by dollars, but also certain things may fall through the cracks. Who knows what can happen if there's so many different coins being launched at the same time? And I think it's hurtful to the industry, and it's hurtful to everyone if everyone tries to go at the problem and do it the exact same thing. Everyone needs to come in and support different sides of the stack. And there's issuers, there's also compliance components, there's also treasury components, and there's so many ways to interact and to be a part of the stablecoin flow that there's no need to have so many different kinds. And I think that it's important. There should be competition, not to say that there should only be one stablecoin. I think there should be many stablecoins for many different use cases, but I think that if everyone launches their own stablecoin, you start to run into issues. And I'll also say, like, if people will launch stablecoins, and then all of a sudden you'll realize how challenging it is to actually manage a stablecoin, how much goes into the compliance of it, how much goes into sanctions, how much goes into issuance and record keeping and attestation forms and accounting. It is a very all-encompassing effort, and if rates drop, it just becomes very, very infeasible for many. So,
good point on the rates. It's an extraordinarily interest rate sensitive business. We went a bunch of years. Japan went a lot of years with zero return on. There was 0% rates. I mean, even their 10-year was paying like 0.6. That's not enough to sustain a business. But interoperability, so from my standpoint, who or how many is not our business. But for this whole thing to work, there's only two things that I care about. One, the stablecoin has to be stable. That means 24 hours a day, not a moment's hesitation, because eventually it just becomes money. And it only does that, right? It used to be the Oklahoma dollar traded differently than the Texas dollar, and that was an issue. Interoperability, that could be all using the same one. Okay, that'll work, but regardless, because we're going to have transactions. And when they start failing, there's going to be backlash from that building right behind us, okay? A settlement of a mortgage where we settle on, you're going to sell my house for $500,000. We agree on that, and you come in with 500,000 USDC. And we're going to have like mixed marriages, right? Where one party walks away with US dollars. We have to be able to treat them the same. You ever go to Money 2020 or any of the big conventions in Vegas? But this is a very Vegas thing. But I was out there in October speaking to all these TradFi folks and it's at the Venetian, and I said, listen, everybody in that town, Vegas, already knows what a stablecoin is. That entire place was built on a settlement token. It's called a casino chip. And it doesn't matter if you gamble or not, what you think about it, that whole ecosystem, all those billion-dollar places, none of it works if there is a moment's hesitation that $100 chip is worth 100 24 hours a day. Not a moment's hesitation. There should never be a moment where it trades at 99 cents. Okay, everything is built, including people's compensation that they take home. The cocktail waitress when you tip, when she says, "Oh, I had a good shift. I got $600 in tips." What she has is 600 clay things with numbers on them. But she's right. It is $600. Why? Because she cashes them in anytime, anywhere. The whole thing falls apart if there's any hesitation. Oh, I doubled down, won $100. Why do we say that? Why'd you say won $100? You're playing with these little clay things. Because it works, because it has trust. And they're stablecoin issuers. They use a settlement token. It doesn't have to be a stablecoin for a settlement token, but they use a settlement token for the same reason you use any, because it's easier than sitting there with cash bills all the time going back and forth. That's why you use a settlement token, but why is that settlement token. It has to be a stablecoin, or none of it makes sense. There wouldn't be a Vegas Strip if there was any of that. And just like stablecoin issuers, there's two things that keep them in line: market risk, your reputation. Right? If word gets out that Caesars couldn't pay out one night, that is terrible. Right? That's awful for their reputation. And then they have their version of the Genius Act, government discipline. It's called the Nevada Gaming Commission, which is extraordinarily strict. If there's a chip out there, you got to pay it on the spot, no hesitation, or there's hell to pay, because none of it works without that. So how many stable coins? I don't care, not my business. I just care that these things flow, that when we do a transaction and I got to give you $500,000 and you come back at me next week with $200,000, it shouldn't make any difference that our contract is USDC or somebody else's, because it should just be money. Right? The same way the waitress says, I got a tip of $5. She uses the word dollars. She doesn't say chip, because it's a synonym and no one has any doubt of it. That's all we care about, because otherwise there's going to be major problems.
So yeah, just to like as you said, like trust is absolutely the most important thing, and like that I think is the key to all of this. Is no matter what, no matter if you're an issuer, if you're launching your own stablecoin, you need to have that ability to call back and say at a moment's notice, I have $1 million on chain. I have $1 million in a bank account. Like, it doesn't work if you don't have that.
Wow. I'll be stealing that analogy. Just let you know now. That was I never thought of it from that perspective. It also brings up this kind of in mind. You mentioned trust. If all stablecoins are sort of backed, by the U.S. dollar, pegged to the U.S. dollar as best they can, what are asset issuers really competing on? Or is this just a race to the bottom? How do you differentiate yourself as an asset issuer in the stablecoin world?
It comes down to trust and usability. Like, one of the things that we really pride ourselves on is our ability to always call back and say, if we have $74 billion on chain, which I believe is our current market cap, like, we have $74 billion in a bank account, and we can redeem every single one of those dollars whenever necessary. We also have interoperability. We have the ability to go not just across many different banks or institutions, but also amongst many different chains. And that's a big differentiator for us. Using our cross-chain transfer protocol, you can move your funds from Ethereum to Injective, or from Injective to Arbitrum, or from Arbitrum back to Injective. Whatever you want to do, you can move it instantaneously and for almost free, if not, I think we charge 1 BIP for our faster than finality transfers, but at regular finality, it's free. And so it's just a way for you to always be able to have your funds wherever you need them to be. And I think those are that's a key differentiator for us. Obviously, we cater to a lot of DeFi, decentralized finance. We also cater to a lot of institutions. And so we try and really drive home key use cases and key value props for those audiences. Other stablecoins have other audiences, and they have the ability to really focus on those and optimize their flows there. But that's how we kind of see our differentiators. Those are two of the major ones, just that trust and interoperability.
Yeah, that brings up a good point there in terms of interoperability. Obviously, Circle launched USDC natively on Injective, but also it was the first multi-VM deployment of a stablecoin. Do you think sort of being able to operate in the multi-VM environment as a stablecoin, is that going to be required along with cross-chain interoperability go forward for stablecoins to become the settlement layer?
I think that there's Injective is far and away one of the most interesting and exciting blockchains that I've come across. I do a lot of research. I love all the chains that we work with, but something that's very unique about how Injective is built is this multi-VM structure. And so you capture a much larger audience, and you have greater usability across many different protocols, decentralized apps, just other players, other holders of assets in the ecosystem. And so it makes it a really unique deployment, and something that we were really excited to be able to do this year. I think that the way that you guys have built the network is really remarkable, and there's so much usability. One, from a just asset issuance perspective, it's not just stable coins, of course. There's a million different types of opportunities that can exist on Injective, and that do exist currently. And second, the fact that it's really built for finance. It's built to be a central limit order book. It's built to help enable more trading activity so that users who are trying to build in, or trying to work in finance or build in finance have a much more seamless place to do that, it's a really exciting opportunity. So we're really happy to be here.
Yeah, we're really happy to have you involved, and I appreciate that explanation for the crowd. I want to flip it back to banks, though. Get this question in while we still have time. I think it's really important for this conversation with stablecoins. Banks argue that stablecoins pull deposits off of regulated balance sheets. Pose that to both of you. What does that argument miss, or do you agree with it? Whoever would like to lead.
I think I would disagree with that. I think that, it's the same thing as saying a dollar in a pocket pulls away bank deposits. Like I think that there's certain use cases that are important for stablecoins. There's certain use cases that are important for bank deposits. There's also certain use cases that are important for treasury bills or for stocks and for other more, call it like riskier assets. Like I think that it's a challenge. It's challenging to kind of put a blanket statement out there. I would say that there's more utility that you get when you have something that is more liquid and more usable. I would say that banks would not like there to be, they want to have as many deposits as they can. They have the ability to lend out the deposits that they receive up to 100% of deposits, I believe, still. And so there's still a lot of, I think, there's a lot of advantage for them to be able to say, well, we want to maintain as many deposits as possible. And for us, we just say, there's more usability when you have more optionality.
I appreciate that. Now, obviously, this is Injective Summit, sort of pro stablecoin, pro RWAs on chain. Do either of you see a coherent argument or lend any credence to the argument that is against stablecoin adoption, just to offer the contrarian view, I think, to the audience, or no?
I mean, the argument that I'd give against it is the U.S. financial system is not, I would argue that it's not broken. It still works. It still functions. We still have trillions of dollars flowing every single day. And for a lot of people, would say, why fix what isn't broken? I would say that there's a lot of things that can be improved, and stablecoins and blockchain are a way to do that, and it's a way to really bolster that. But I understand when people say, well, I actually don't mind waiting my 2 business days, which could end up being 3 actual or 5 actual days, depending on when you send it. And for them, maybe that's okay. In my mind, it's an optimization problem, and there's a lot that we can improve there. But I think that's an argument that I would maybe hear and say, okay, I get that.
I mentioned so obviously I, as an insurer, care whether or not credit unions get in trouble, right? And at some point, the U.S. taxpayer should care. But it is possibly competition. There's a couple points I just want to make on that. I know you directed that to him. On this issue, banks losing deposits, okay? I just got a letter yesterday. It's addressed to myself and Comptroller of the Currency, Chair of the FDIC, and as well as the Fed, 4 agencies, okay? And if these new products begin attracting significant amount of deposits, public letter, by the way, I'm not betraying anyone's confidence. If these new products begin attracting significant amounts of deposits from depository institutions, we're concerned this flow of funds away from depository institutions means a decline in their ability to meet the credit needs of their communities. Oh, wait, my bad, I'm sorry. This is a letter from 1980 from the same institution about money market mutual funds. Sorry, my mistake. Here's the one from yesterday. Yield-bearing stablecoins risk averting deposits to crypto firms, eroding the ability to meet the credit needs of their communities. So that's part of my answer. I'm being a little flip, but that's part of my answer. Also, I think people, as often forget that there's this thing called other countries. 80% of current dollar stablecoins outside the United States. If a bunch of money flows into stablecoins, it's expected to be, a lot of it Asia, Africa, Latin America, some of whom have way more need than we do because we have easy access to dollars. When we think dollar stablecoins in America, we tend to think about the stablecoin part of it, that it's a useful settlement token, et cetera. Outside our borders, the dollar stablecoin phrase, the dollar part of it is the key part of it. To have access to a stable currency in some parts of the world, it is a life raft. It is tremendous for payments to not have to go in and out of their other currencies. And it is why 70% of the House and Senate voted for the Genius Act. That's the meta thing. It doesn't, even if you don't understand on-chain or coins or settlement tokens or any of that. What any member of Congress said, do you understand we have 40 trillion in debt? You know it costs a fortune. You know it drives up costs for everybody. It makes mortgages more expensive. Do you want to keep the US dollar the global reserve currency? If the answer is yes, support this bill, okay? You can't get 70% of Congress to agree on what day of the week it is. And they agreed to that. My point being, this money is supposed to go from all over the world to dollars, which means you park it in treasuries. That's why it was so important it went into treasuries. It's supposed to be a treasury buying machine from outside the United States. Trillions of dollars from around the world flowing into dollars, which means they park it into US treasuries, which makes our borrowing costs lower, which lowers interest rates, which lowers mortgage rates, allows us to do, when we need them, sanctions, because we can only do it because of the dollar network. No other country can do sanctions like we can. We do it because of the dollar. And once that's gone, none of us in our lifetime have had it where we weren't the reserve currency. Ask the British what it's like when it's gone. That's a very, very different life. And since World War II, it's been the US dollar, and the Genius Act was about that. So anything that disincentivizes holding stablecoins goes against that issue. It goes against the goal of keeping the dollar, the reserve currency. It raises interest rates because the Treasury has to work harder in its auctions to sell the debt. They're supposed to be treasury buying machines. So, and why, so to the point of the deposit flight, per se, a lot of the money has nothing to do with the United States and has nothing to do with American depository institutions. And by the way, the Genius Act only applies to US issuers. You're still going to find a yield-bearing dollar stablecoin. It's just not going to be one of the ones subject to the Genius Act. It's going to be from one of the other 195 countries in the world that already exist. So I do think it is a bit overstated. By the way, the one I read from 46 years ago, 1980, this letter from the same organization, back then their argument was they were trying to say that they, the banks, should be able to offer the same product. Back then they couldn't offer money market funds. So that was a real problem. They weren't arguing to ban anybody from yield. They were saying let us in on it too. Took an opposite approach last year, which is instead of saying we want to be able to offer the same yield so we don't lose anybody, it was nobody can pay yield. It's just a different approach. It's interesting.
No, I think that's incredibly important. And you had me at lower mortgage rates.
So that does counterbalance. Let's say there is some deposit flight, okay? Let's say there is from America, even though most of the money's not going to be from America anyway, but let's say it does make it harder, okay? And it does, there's two other counter effects to that. One is, what they're going to say, the argument is, well, if we lose deposits, that means we're going to have to raise our lending rates because, you know, deposits are a cheap source of funding, and if we lose that, our lending rates for car loans and mortgages and stuff are going to go up. That's a fair argument. Okay, let's just say that some of that is true. Well, in that, what has also happened in that situation? That means stablecoins have taken off. That means the globe is buying treasuries. So you also have a force that is lowering rates, okay? I'm not here to say which effect is bigger. I'm saying that is a force against it. That's global treasury buying lowering rates. So your mortgage rate may not be lower, even if that institution lost some deposits and had to raise its rates in a secular sense, because you have that other purpose. Also, we might not need as much debt. If we were all earning yield on our idle cash, there might be a little less demand for loan, right? If I earned $1,000 last year on all my idle cash over the course of the years, yeah, I still need a mortgage to buy a house, but I need $1,000 less debt to do it. So those are two other effects. So when you hear that argument about it's just going to make, we're not going to be able to offer you competitive loan rates, there are other effects going in the opposite direction to lower rates.
Yeah, no, definitely. We're coming up on time here. We got 60 seconds left, but I want to give you both an opportunity. 3 years from now, I just want one prediction out of each of you. What does settlement actually run on?
What I care about is at least one U.S. government transaction running on those. It doesn't have to be retail like Social Security payments or tax refunds. I would like to see at least one transaction maybe to a foreign government or internal, because I think that's important, that the entities that regulate have firsthand usage of these things.
I just want to see 3 years from now that, you know, that stablecoins and crypto in general are more well accepted in government. Like I know like it's different from the question, but I think that it's important to just be like that we can all align on like the fact that this is a objective improvement to our current system.
It'll just be money. You won't say stablecoins. The same way we used to say, I bought plane tickets on the internet. Now you say you just bought plane tickets. You probably bought them on the internet, but we don't have to say that anymore. I just sent some money, right? That's all it is. It's just transfer value. That's what I hope happens.
For sure.
Well, amazing. Thank you, Spencer. Thank you, Chair. Really, really appreciate your time. I hope everyone enjoyed it.